Peter is a 66-year-old Australian resident who is married with children. During the current tax year, Peter derived salary income, a net capital gain, and received fully franked dividends. Peter also had deductions which all related to earning his salary. Peter has adequate private hospital health insurance cover and had tax withheld from his salary by his employer during the year. Peter's wife Fiona does not work. She received a disability support pension, had an adjusted taxable income of $5,500 including the pension, and was not entitled to nor claimed any family tax benefits. So how do we work out what Peter's liability is for the tax year? Let's start with the formula taxable income equals assessable income less allowable deductions. We then determine gross tax payable on the taxable income, subtract non-refundable tax offsets before we add any applicable levies, less refundable tax offsets, and finally we subtract tax paid. This leaves us with the tax refundable or payable as our balance. So for Peter, step 1 requires us to determine his taxable income. Peter's salary is ordinary income and the dividends received are statutory income. The dividend is grossed up for the franking credit by multiplying the dividend amount by the tax rate and then dividing by 1 minus the tax rate. The net capital gain is also included, which being the net gain assumes that discounts, if any, have already been applied. Adding these together gives us Peter's total assessable income. We then subtract Peter's allowable deductions to work out Peter's taxable income. For step 2, we determine the basic income tax liability payable by referring to the general tax rates for the range in which Peter's taxable income sits. And finally, step 3 requires that tax offsets and any additional charges and levies be taken into account. As Peter's wife Fiona was in receipt of a disability support pension and was not working, she qualifies for the Dependent Invalid Carer Tax Offset, or DICTO, per section 61-5. This is a non-refundable tax offset and therefore needs to be deducted from gross tax payable first, before any additional charges and levies are taken into account. In this case, Fiona's adjusted taxable income is used to determine the DICTO. This is subtracted from Peter's tax payable, not his taxable income. The Medicare levy is based on Peter's taxable income. We now work this out and add it to Peter's tax payable. Peter is also entitled to the dividend franking credits because he received fully franked dividend income and the fully grossed up amount was included in his assessable income. Finally, Peter paid tax this year and therefore has a PAYG credit which is now subtracted from his tax payable. We have now determined Peter's net tax payable. To recap, you need to be able to calculate taxable income and then tax payable for a resident individual. Note that gross tax payable must be reduced by any non-refundable tax offsets, such as the DICTO, before adding any applicable levies. From this, any refundable tax offsets and any tax paid are subtracted to give the net tax payable.